In this video, we're going to talk about why ETFs are extremely beneficial for those who are investing in the stock market for the first time. So we're going to go over what an ETF is, a few of the benefits that you have looking forward to when investing into an ETF, and I'm going to give you guys 5 ETFs that I'm currently investing into right now that you definitely want to check out for yourselves. So you might have heard something called an index fund at one point or another. There's the Dow Jones Index Fund, the Russell 2000, the NASDAQ 100, and the most popular one from my knowledge is the S&P 500. And all these index funds are used to give a general idea of how the stock market is doing within a period of time. An index fund is basically a basket full of stocks. So for every dollar you put into an index fund, that dollar gets divided into a plethora of different companies that are within it. The S&P 500, for example, is an index fund that tracks the top 500 largest companies within the US stock market. So anytime you invest into the S&P 500 index fund, your money gets divided into each of those 500 companies within that S&P umbrella. Index funds are very revolutionary for a lot of reasons, and it's something you can invest into right now. But the one thing that people may not be too crazy about when it comes to index funds is the amount of trading you can do with it. With an index fund, you can only buy or sell it one time per day at the end of trading hours at that exact price. And that's where we introduce an ETF. An ETF, or an exchange traded fund, is basically an index fund, but the biggest difference between the two is that you can trade an ETF just like you can trade a regular stock. So you can buy it, you can sell it the same day, you can buy 10 more, sell 10 more, do options, you can even day trade it if that's something that you want to do with an ETF for whatever reason. Point is, it's essentially a stock. But of course, there are other things that are really cool about ETFs, and they'll definitely explain why they're super beneficial for those of you guys that are investing into the stock market for the first time. This first reason is more of a token reason, because for maybe 95% of investors out there, it's not really something you have to worry about, but it is pretty cool knowing. And that's the fact that you're spending less money in commissions when you invest into an ETF. So a commission is the fee that a brokerage charges their investors for handling their money, whether they're doing a buy, a sell, some type of option, or anything in regards to moving money from one place to the next. But after Robinhood, which I believe became the first brokerage app to offer free commission trading, a lot of other brokerage apps followed suit. But surprisingly, I was able to find a few brokerage apps that did still charge commissions, even though it's a pretty low fee. But regardless, if you happen to be interested in investing through a brokerage app that happens to charge a commission fee, then investing into an ETF would save you a lot of money. Let's say that ETF has 50 stocks within its umbrella. Instead of having to invest into 50 separate stocks to create that portfolio and pay 50 different commission fees, you can buy one ETF, pay one commission fee, and have that money divided into 50 individual stocks within that umbrella. But again, this is something not a lot of people should be dealing with. But the one thing you would be dealing with in a good way is the convenience ETFs give you by having a diversified portfolio. One fear that it seems like a lot of new investors have, especially myself, is the fear of putting your money heavily into the wrong company or the wrong set of companies, and when that company does bad, you lose the bulk of your money. With an ETF, you have the convenience of having your money divided amongst numerous amounts of companies, whether it's double-digit companies or there are even ETFs that have hundreds of companies within their umbrella. The benefit of that is if you happen to have one or a few companies that on a few days don't do a great job in the stock market, they release some bad press, just something happens and the price of those goes down, then you have a higher probability of having your other companies offset those losses to where they're potentially non-existent. Of course, depending on the ETF you invest into in those specific companies. Over time, as you become a more experienced investor, you understand what to research, you understand how the stock market works on a yearly basis, then you'll have more of an idea of what companies to invest into that would generate the most growth over time, and you won't have to necessarily worry about investing into 20, 30, or 40 different stocks to be more diversified to offset potential losses. In the time being, this gives investors more opportunity to get into the stock market and avoid those fears of losing a lot of money. Another thing that I've noticed that keeps a lot of people from investing into the stock market for the first time is not understanding what to research or taking too much time to research even one company. For a new investor, even having a portfolio of just 5 to 10 stocks can be a lot for someone, especially when you're trying to figure out what to research for each company. Being passively managed, ETFs will adjust with the stock market as time goes on and companies become more profitable, or they lose profit, or new companies get added, or companies go bankrupt and subtract themselves from the stock market altogether. So the benefit of that is you're investing in one ETF that has one particular goal and picks stocks or companies within in the stock market that meet that goal. So as long as you believe in the goal, then you can believe that the companies within that ETF will generate you profit at the end of the day. And over time, as you hopefully grow profit from that ETF, you can understand what to research till it doesn't seem as aggressive when you're researching more than one company that you want to add into your portfolio. The fourth thing, and one of my favorite things about most ETFs, is that they pay a dividend. Honestly, one of my favorite reasons why I invest into the stock market is making passive income in the form of dividends. On top of saving money from commissions if you're investing into a brokerage app that charges it, having something that diversifies your portfolio automatically, and the lack of intense research that you're avoiding at the beginning phases of your investing journey, you also have the reward of getting paid dividends just for simply investing into those ETFs. A lot of those ETFs, just like most stocks, pay you every quarterly, but there's even ETFs that also pay you monthly. But even with all that good news, there is one thing you definitely want to keep in mind as a brand new investor that is definitely persuaded to look into ETFs as their first investment, and that's something called an expense ratio. One of the benefits of an ETF was in regards to them being passively managed. They're passively managed because just like an index, they are live tracking a certain segment of the stock market, and over time the stock market will change. Again, companies will become more profitable, they'll lose profit, things of that nature. So with that being said, you can imagine that there are people in the background of those ETFs, because ETFs are owned by specific companies, and in the background, they do all the tracking. They're managing those ETFs. So because of that, and the fact that you get to avoid most of that research, you have to pay them a fee, and that fee is the expense ratio. It's commonly presented as a percentage, and it's a percentage of the amount of money you hold into that ETF on an annual basis. Now that percentage for ETFs is fairly low. Typically, the lowest end is 0.05%. The highest end I've seen is 0.75%. So for example, if you invest into an ETF that has an expense ratio of 0.75%. That means if you hold $10,000 in that ETF within a year, then you would get charged $75 for that year in expense fees. $75 is a decent amount of money in itself, but in comparison to $10,000, it may not be much, but good news, there's a lot more ETFs whose expense ratios are even lower. Now, with all that being said, here are 5 of my favorite ETFs I'm currently investing into right now that you should definitely look into as a first investment. This first ETF has a ticker symbol of QYLD. It's an ETF that tracks the NASDAQ 100 index. The NASDAQ 100 is an index fund that tracks the 100, I believe, largest and most traded companies within the NASDAQ stock market, and the majority of those companies are tech-based. What's really cool about QYLD is that it is one of those ETFs that does pay a monthly dividend. So for those of you guys that really like consistent checks, this is one of the ETFs that will give it to you. And what's really interesting about QYLD is how it gets that money to pay its shareholders every month. So this ETF sells covered calls. Now, I'm not gonna get into the weeds of what that is in particular, but it's basically a type of option. And if that option succeeds in your favor, then you could receive a premium of whatever amount. In this case, they track the NASDAQ 100 and they sell covered call options on particular stocks within the NASDAQ 100. And then when they receive those premiums, they disperse those premiums amongst the shareholders in the form of monthly dividends. So the monthly dividend you would receive for investing into one of these ETFs is about 16 cents per share, which is not too bad for an ETF that's roughly a little under 30, maybe even mid $20 per share at this moment. One thing you want to keep in mind is that the expense ratio is about 0.6%. So that'd be $60 for every $10,000 you invest into it per year, but still not bad. The next ETF is SPHD. It's an Invesco-based ETF. It happens to be one of my favorite monthly dividend paying ETFs, which I know is super specific, but the reason why is really cool and something that I really think caters to brand new investors. So as I said earlier, the S&P 500 tracks the top 500 largest companies within the domestic stock market, or companies within the United States. What SPHD does is it takes a look at all those companies and it picks the top 50 highest dividend yielding stocks and the least volatile. So the ultimate goal is to be able to give you monthly dividend checks and you not have to worry about it dealing with so much volatility unless it's just tremendous. Kind of like what happened with the pandemic, unfortunately. But as you can see, it was able to recover over time. The monthly dividend for this ETF is a little bit lower at about 14 cents per share. And I believe its actual share price is a bit higher than QYLD. However, its expense ratio is half of QYLD. So if you're investing a lot of money into this over a given period of time, you would be saving half in expense ratios. The next ETF is ticker symbol DIV. It's super similar to SPHD along the lines that it tracks 50 high dividend yielding yet low volatility stocks, but it's different because it tracks it from a different index fund. It's also different because the sectors within it are different. The sectors within DIV are primarily energy, real estate, and industrial, whereas SPHD is utilities, consumer defense, which is basically food and beverage, and healthcare. DIV is yet another ETF that happens to pay every single month at 10 cents per share, which is really cool, especially on my end when you add that SPHD and QYLD and you're making almost 50 cents per month just for owning one share of each. Really cool stuff. As you get more interested in ETFs and making dividends as a passive income in the stock market, you definitely want to check out another ETF with the ticker symbol SCHD. It tracks a Dow Jones index fund that primarily focuses on the top dividend yielding stocks that also have a very long history of paying out its dividends. Because the one thing you want to avoid is having your dividends interrupted for whatever reason. What's really cool is that some of the top companies in its sector not only have a long history of paying dividends, but they have just as long or even a longer history of increasing those dividends annually. There's one company that I believe has increased their dividends over the past 11 years. Pfizer might be a company with them that's also increased their dividends for 11 years. And Pepsi has increased their dividends for the past 50 years, which is intense. So at this point, we're kind of gravitating away from the monthly dividend paying ETFs because this one happens to pay quarterly, but it does pay you 63 cents every quarter per share that you have of this ETF. But really cool news is that its expense ratio is on the significantly lower end at 0.06%. So that means for every $10,000 you invest into this ETF, you would only be getting charged $6 per year. So not a lot at all. The fifth one that I invest into, and this might actually be my favorite ETF out of all five, is ticker symbol VTI. VTI is the big boss of maybe all ETFs. It tracks every single stock in the stock market. If you actually look them up, you'll see that they have over 4,000 stocks in the stock market and growing. This ETF is the epitome of diversifying your portfolio. Every dollar you put into this ETF literally gets divided amongst virtually every company that's available to be bought and sold in the stock market. On top of that, it has the lowest expense ratio on this list of 0.03%, half of the last ETF we talked about. And at this point, it pays an 80 cent per quarter dividend. Now, this ETF, as far as share price, is on the upper end. I think right now it's almost in the 200s per share. But with fractional trading, which is something you definitely want to be looking into as a new investor, this shouldn't be as much of a threat. And over time, you will build the amount of stocks you have and alongside the amount of dividends you're getting paid. Knowing what I know now, I definitely would have invested into an ETF as my very first investment into the stock market. This is definitely something that you'll hopefully suggest as well. And hopefully you'll avoid making a lot of the financial mistakes that I made as well in the past, including not even investing in the first place until I was late in my 20s. But if you're more interested in that, make sure you check out this video that's going to give you more insight on a lot of the mistakes I made, but more importantly, how you can avoid those so you can avoid being, broke when you're a little bit younger. I hope you enjoy that video, just like I hope you enjoyed this video as well. And until next time, guys, take care.